The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm welcome to Squawk Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattelbaum, and these are your headlines. HSBC announces a $3 billion buyback, whilst Deutsche Bank posts a top and bottom line beat. BP numbers are just crossing the wires. We're going to talk through the numbers with the CEO, Murray Auchincloss. That's the CNBC exclusive just ahead.
Power starts to return after Madrid declares a state of emergency as Spain and Portugal are hit by an unprecedented countrywide outage, grounding flights, paralysing transport and suspending mobile and internet systems.
And a comeback for Canada's Liberal Party, Mark Carney winning the federal election, setting up a showdown with President Trump on trade and independence.
Well, there's no doubt these are a very important set of numbers for BP and its CEO, Murray Auchincloss, who we're going to speak to in a few moments' time. Let me just run you through a few of the headlines. Net income has come in at $687 million in the first quarter. The net debt, which again is another big area of focus, circa, and I'll round it up here, $27 billion US dollars in the first quarter. Operating cash flow, again, another pivotal number. We'll come to this in a moment, why these are pivotal numbers. 2.83 billion US dollars, and the adjusted net income $1.38 billion versus an estimate of 1.625. So a slight miss on that figure there. But I do want to, actually, I'll do the CapEx as well, because again, every single one of these numbers is going to be poured over by the community and indeed by the shareholders. The CapEx around $14.5 billion. And they're all quite contentious numbers for some of the shareholders. But I'm delighted to say Murray Auchincloss, the CEO of BP, joins Squawk Box now. Murray, really, really good to see you again. We go back quite a while as well. So look, you've got a real focus now. You announced in February the big update. You've got 4 things you want to focus on according to what you said at the AGM: cash flow, costs, debt and high returns. Murray, how difficult is it to execute on those 4 key metrics in the current environment?
Hi, Steve. Thanks. Nice to see you again, and thanks for having me. It's appreciated. Look, we had a great operational quarter. We had our highest upstream operating efficiency in history. Our refineries in the first quarter ran at the best they've run in 24 years. We had 6 exploration discoveries in a row, which is really unusual, and we started up 3 major projects. Right now, we're focused on delivering that strategy you talked about that we laid out to grow cash flow from $8 to $14 billion over the next 3 years, and we're off to a great start in 1Q.
You are under a lot of pressure, Murray, not least from the macro environment, but also, of course, from investors, namely the fact that you now have an investor who is activist on your shareholder roster, with Elliots owning circa 5% as well. How much pressure are they putting on you for a more aggressive strategy than the one you outlined in February?
Look, we don't really comment on interactions with investors. But of course, we've laid out a good strategy 9 weeks ago to grow the cash flow from $8 to $14 billion. It included a divestment target of $20 billion, and we're off to a great start. $1.5 billion already delivered it after the first quarter. And we talk about decreasing our costs by $4 to $5 billion. That's 25% on top of the 25% we did earlier in the decade. We've got aggressive plans, we're fast in action, and we're in delivery in 1Q.
In terms of the pressure that the macro is putting on you as well, there is no doubt about it, and the copy was all about this in advance of the broader earnings season for the oil majors as well, the energy majors I should say as well, is that the low oil price, and we are currently trading on Brent, well, circa $65 a barrel as well. Does that put a lot of your plans stated in February in jeopardy?
Not really. We have a balance of products that we think about that generate revenue for us. It's oil, natural gas, and refined products as well. In the first quarter, the oil price averaged $74. Right now, I think the year we're forecasting to be around $67.50 using the forwards. Natural gas, we're largely hedged, and refining margins are coming back up. So overall, we're relatively balanced across the three products that generate revenue, and we're off to a great start, as I talked about. Out of an abundance of prudence, we've done two things. First, we've trimmed capital by $500 million in the quarter. That just seems a sensible thing to do, and we've accelerated divestments. We're off to a great start. We're now increasing our divestment range from $3 to $4 billion, and we think that's more than enough for now to take care of an external environment.
Murray, it's Karen jumping in. Good morning to you. Let me just extract a bit more detail around the share buyback, because the market was pointing to the drop in the oil price to your potential and what you can still do on the share buyback. We can see the $750 million maintained today. But where does it go from here? Because some think that will shrink even further from here in coming quarters. Is that the case?
When we laid out our financial frame, we said that we'd be having a dividend increase of 4% per year. That was what we were focused on. We're also focused on reducing our net debt over the next 3 years to around 14 to 18 billion, principally through the divestment program that we talked about that's off to such a good start. We'd invest 13 to 15 billion of capital. And then out of excess cash, we said excess cash would be shared with shareholders through buybacks, and that's what the 750 million is. We said within a range of 30 to 40%. As we look forward, we're not predicting what the buyback will be in 2Q or beyond, given macroeconomic uncertainty. But what shareholders can count on is that out of excess cash, they'll get 30 to 40% of both the dividend and buybacks to top that up. And that's our commitment to the market.
So still somewhat of a cloud then over where we go to on that buyback. Let me ask you then about the divestments, the 3 to 4 billion that you spelled out for this year. What have you achieved so far this year? And what about the questions that the activists are now raising the market as to whether you should hold on to the petrol network, which is really the consumer-facing part of the business that some drivers really see BP day in, day out in terms of that visibility of the brand?
Yeah, there's a lot of interest in the assets that we have on the market. We've already achieved $1.5 billion decapitalizing some pipelines. We've bumped the range to 3 to 4 based on the strong interest we're seeing across the transactions that we're doing. And of course, we've launched our process on Castrol as well, a great brand that's performing very, very well, 7th quarter in a row. As far as the retail network, et cetera, we're an integrated energy company. We have a big trading division. In order to trade effectively, you need to be able to sell the product into markets, and that's what the retail markets do for us, both storage terminals, retail stations, and refineries. So that's very, very important for an integrated energy company. And what we've committed to do is churn 10% of that portfolio. So we've started that with the announcement of divestment of Austria and the Netherlands, and we'll continue to high grade that over time.
Can I just turn to the CapEx? The number you've spelled out today, the $14.5 billion, smack in the range of where you've been guiding for annually. But the market here is also wondering how much of this will go towards renewables, how much of it is sustainable, given that there's a bit of shift in the business recently. Just walk us through the thinking here and what is a priority now when it comes to CapEx.
Yeah, so when we laid out our program to grow our cash flows from 8 to 14 billion, it included a capital range of 13 to 15 billion. We originally guided 15 this year. We've trimmed that to 14.5 based on capital efficiency and choices we're making. We are back to growing the upstream, so we're investing 10.5 billion into the upstream. We are fine-tuning and focusing our downstream business, so we're investing around 3 to 4 into that business. And then renewables, as you say, very, very capital light. We formed new partnerships with JERA Next to decapitalize our offshore wind business, so we get the electrons with very little capital. And our solar business will bring in a partner. We'll start that process in the 2nd quarter here. We'll bring in a partner. And again, that means not much capital goes into it, if any at all, but we get the electrons for our trading business.
Murray, people are making a lot of comparisons between yourself and the US oil majors. In fact, I think you've been making the same comparisons, trying to redress the gap between the valuations for, say, an Exxon on 15 times forward as one measure and BP sub 10 as well. What do you think is the biggest barrier to closing that gap?
To be honest, is growing cash flow. We think that share price depends on at what pace you grow cash flow and how confident the market is in that. We have sector-leading growth going from 8 to 14 billion across the next 3 years. That's 20% compound annual growth. And having talked to 75% of our institutional investors, they're supportive of the direction of the strategy, and they just want to see us deliver. And I think if we deliver that cash flow growth, that starts to close the gap for sure. And we've had a great start in 1Q.
Murray, do you think you're a takeover target? I've got to ask, you're a £57 billion company, which seems huge by British standards, but Exxon is worth, I think, just shy of $500 billion as well. A lot of people have been talking about you in the crosshairs, given your huge US assets as well. Do you think if the operational improvements don't come quickly enough, that you will be a takeover target?
Look, I'm not going to speculate on that. What I will say is we're a strong independent company and we've got sector-leading growth. And if we can deliver the sector-leading growth, and the first quarter is a fantastic example of that, then I have no concerns. I think we're going to do great.
Have you asked for protection from the British government, some form of golden share or something, just to kind of keep the predators away?
No. We're a strong independent company, and we remain focused on growing cash flow and growing returns for shareholders.
Final one from me before Karen jumps in as well is just tell me a little bit about the environment stateside as well. We know that OPEC is putting production back on the table, which seems extraordinary at these levels, given the fact that they need such a much higher price as well. But the US administration, we all have heard it a lot from the administration, it's about drill, baby, drill. Is that helpful at the moment, Murray? Is it increasing more production stateside? A lot of people are worried, actually, that the increased production isn't needed at this stage of the cycle.
Well, look, I think a few things. As I reviewed the business last week, demand across all the businesses has not changed yet. There's lots of concerns about change in the future, but so far we haven't seen any dampening in demand in aviation, transport, etc. I think the second thing to think about is there are a lot of different variables out there right now on what's going to happen to price. It includes OPEC Plus, as you mentioned. It includes the U.S.-Iranian relationship. And then, of course, supply. And as Brent dropped below $70, we started to see some activity start to fade. I think if you look at the United States, the drilling rig count's down 10% year on year now. So it seems like as Brent drifts below $70, you'll start to see some supply pressure as well. As far as the United States goes, we're focused very much on growth, growing from 650,000 barrels a day to 1 million a day by the end of the decade, and pleased to help the administration in their energy dominance agenda.
Murray, we've danced around the topic of some of the demands from Elliots, the activist investor, but can I just tackle it head on? Because they seem to be very active behind the scenes, if reports are right here, and you've been in dialogue with them around some of the major demands around cost-cutting and asset divestment. What sort of engagement are you having with Elliots right now, and how close are you, do you think, to really appeasing some of the concerns that they've had?
Look, we don't comment on interactions with individual shareholders. What I will say is we put out a very aggressive program, and we're fast in action. The 8 to 14 billion of cash flow growth, we're off to a strong start. On costs, we reduced by 25% earlier in the decade. That's another 25% now, very aggressive, and we continue on track with that. Costs actually dropped by 500 million between the fourth quarter and the first quarter, so we're doing very well. And we had a blockbuster divestment program of 20 billion. We've already delivered 1.5 billion of that the first quarter in. So we are aggressive in action, and I'm confident in growing cash flow, which is what all of us want.
The lingering questions in the past 24 hours about energy security, thanks to the power outages in Spain and Portugal. We know geopolitical landscapes are moving very, very quickly right now. How are you perceiving the need to balance energy security with a further push towards renewables?
I think over the past 5 years, the world's changed an awful lot. Conflict in Europe, COVID, recession has really changed the conversation with governments around the world. For instance, I was in India the other week, and energy demand's growing at 14% per year. So most nations around the world are now focused on energy of any form. Of course, they'd like it lower carbon, but the priorities are security, affordability, and then emissions. So I think we're in an energy additive phase right now in the world, and people are just looking for firm supply that's local and that's affordable.
Murray, it was a bruising AGM with Helge having quite a large vote against his reappointment. I know he said he was stepping aside anyway. We know Amanda Blank is searching for replacement chairman as well. How close are we in that process of finding a chair? Because you pretty much need the ally, I guess, in the boardroom at the moment.
Well, as Amanda said at the AGM a couple weeks ago, the process is launched. We're not going to give a step-by-step commentary on it, but the process is launched, and as Amanda said, she's in action fast and moving fast. So we'll update the market in due course, Steve.
Really good to see you today, sir. Thank you very much indeed. I do genuinely appreciate you taking all the questions from Karen and myself, and we look forward to speaking to you again soon, Murray. Thank you very much, sir. Murray Auchincloss, who is the CEO of BP, speaking exclusively to CNBC.
On a programming note, it's a packed week here in Europe. We'll be speaking with Nicolai Tangen, CEO of Norway's sovereign wealth fund, NMIM, today. And tomorrow we'll bring you conversations with UBS CEO Sergio Armati, Barclays CEO Venkat, as well as the chair of the Northern Powerhouse Partnership, Jim O'Neill.
Let's revisit this story we were just talking about. Power has started to return to Spain and Portugal after a huge outage brought large areas of both countries to a standstill on Monday, also briefly impacting France. Spain has declared a state of emergency, with authorities across the Iberian Peninsula still working to determine the cause. Well, Charlotte joins us with more. Charlotte, I think we're all picking up the phone to relatives in Spain to see how the situation was, because it certainly looked bleak.
It did, but look, things have been completely restored this morning. So certainly this is the good news. But at 12:33 CET yesterday, a complete outage, 60% of the whole country's power was lost within 5 seconds. So you had these surreal scenes of the shops going dark, the traffic lights going dark as well. So there was no public transport. The hospitals turned to generators as well. So things are recovering. And now, of course, the public transport will take a while to recover fully. Trains and planes, the backlog from yesterday, but things should come back. There was no panic yesterday. We did see people rush to buy water or toilet paper or candles, expecting maybe a night in the dark. But from what we heard from the communication in terms of reasons from the Prime Minister Pedro Sanchez, there's no explanation yet of why this blackout happened. They say they're not ruling out anything at the moment. Everything is still on the table. They're investigating, which means that a cyber attack could still be the cause, but also still be an equipment failure. According to the EU Agency for Cybersecurity, they said that for the moment, the investigation seemed to point out to a technical or cable issue that are closely monitoring the situation. So we have to wait and see what happens there. In terms of cost, well, there's no estimation just yet. What we know is that Spain, the wealth production of Spain is 4.5 billion euros per day. So considering that this blackout happened at around midday and that it gradually recovered, it could be an impact that is much smaller than this. But this is the number that we've seen so far. We have to wait and see. For the Spanish power situation, you remember that back in 2022, it benefited from the Iberian exception, so being out of the European way of putting the cost of electricity, because it is not very connected to the rest of the bloc. They are connected to Algeria for their power. They also have a high renewable generation. So that's one thing that probably a conversation that will be happening going forward. Does the peninsula need to be better connected to the continent? That is a conversation that's been happening with France as well.
Right.
But that doesn't stop blackouts. Back in 2003, there was a blackout in Italy because a tree fell on the line in Switzerland. So there's all these issues.
But Charlotte, coming back to the blackout yesterday, I mean, this was extraordinary to see the impact and the breadth of the blackout and the fact that we really don't have any further insight here. Flesh out what are the sort of top contenders as the likely reason. I've seen everything from extreme weather to a potential cyber attack, but the authorities don't seem to be steering us in any particular direction.
No, and that's what the criticism that they're facing. They've been updating, giving information to the population over the day, but there's still no explanation. Certainly we saw the leader of the opposition in particular taking great criticism to this. Also because there's an EPP Congress in Valencia, and the leader of the opposition is from the EPP, the centre-right party. So a lot of these centre-right leaders from Europe are all gathering in Valencia while this is happening. So, that might give them an insight as well. It's also interesting that the Commission just a few days ago told European citizens to have a 72-hour emergency kit, have batteries, have water in their bag. And you have this conversation in Spain saying maybe we should. You have natural disasters, you have moments like this where maybe we should have this kit ready.
Charlotte, thank you for bringing us the latest on what was an extraordinary story to watch unfold over the last 24 hours. Coming up on the show, DWS profit soars in the first quarter. Annetta will join us to break down the numbers with CFO Marcus Kobler after the break. And HSBC initiates a new share buyback after beating estimates in the first quarter. We'll break that down for you in around 15 minutes' time. And Novartis posts double-digit sales growth and raises its full-year guidance. We'll be joined by CEO Vas Narasimhan for an exclusive conversation at 7:30 BST.
Right, it was actually something very rare yesterday. It was quite a calm session on the US markets. We saw the Dow up 114 points, the S&P up 4, and the Nasdaq down 17. I was going to say earlier this month it would have been a bruising month for the major indices, but actually, whilst the Dow has had a dreadful month, down 4.2%. We have seen the Nasdaq up 0.4 with the recent rally, the S&P down 1.5% on the month to date as well. But Asian markets, a lot of focus there.
Overnight, it has been mostly higher trade for the Asian equities. You've got the Shanghai Composite trading about 5 basis points higher at the moment. The South Korean Kospi trading about 0.5% higher. The Hang Seng down slightly. Japanese markets closed today, so you don't see the Nikkei 225 up on your board. As for European markets, let's take a look at where futures stand. The Stoxx 600 yesterday gained about 0.5%. Its fifth positive session in a row. That was for the main benchmark, the first time since January we've seen that positive run. And now this morning we're looking at another positive start to trade as investors focus on earnings on both sides of the Atlantic.
A lot of focus on the German economy, of course, and where the firepower fiscally is going to be targeted. I think that's a great interest to the German asset manager DWS, which posted a 15% rise in revenue. You can see the one-year performance on the shares, by the way, up around about 14%. They were boosted by strong long-term net inflows. Well, this is a great moment to get more from the company, and Netta has more.
Thank you so much, Steve. Yes, indeed. I'm joined by Markus Kobler, who is the CFO of DWS. So thank you very much for joining. You had the second best quarter in company history, I assume. So what has been driving this result?
Well, we are very pleased with a few developments. We had a strong start into 2025. And as you mentioned, the second best quarterly financial results of the history of DWS. Our ability to grow organically remains strong. Total net flows at almost 20 billion, another record at DWS with about 12 billion of long-term net new assets. We have been making significant progress in executing on our strategy and increasing return to our shareholders. Year on year, both profit before tax and net income are up by about 36%. Our operation efficiency has also improved. Our cost-income ratio is slightly above 62%, which is an improvement almost 6% year on year. So overall, in a nutshell, a very strong result.
Let me ask you about the effects of this uncertain and very volatile market on the asset management business, especially in Europe. Are you a net benefiter from the turmoil we are seeing in the US?
It helps to be an active asset manager in these times. We probably have seen peak volume in volatility. However, we are entering uncharted territory for the rest of the year. I mean, the tail risk remains high, and the single most important driver there is the US government. However, in such situations, all challenges always offer opportunities if you're able to translate uncertainty into risks, into scenarios, as well as solutions. And we at DWS, there are a few things which are currently playing in our favor. We have reweighted early, and as a consequence, the investment performance of our flagship strategies have been holding up well, both compared to the benchmark as well as to the peer group. To give you just one example, the Top Dividende, one of our flagship funds in the value segment, with almost 20 billion of assets under management, is up year to date at 1.4%, 10% ahead of MSCI World. What we also see is a rebalancing away from the US with an increased interest in Europe and Germany, and there we as DWS, we are increasingly perceived as the gateway into Europe.
It's an interesting one because I think I've never witnessed a period where Europe actually really has outperformed the US. We've been talking about that to happen for many years. So do you think this will continue, especially also for the German market, that we are outperforming the US markets?
There are certain trends which are reversible and there are certain trends which are irreversible. And we believe now if the governments, not just in Germany but in Europe, are catching up what is out there in common vision, also in terms of infrastructure. So this catch-up effect is leading to an increased demand for capital, and that's why I believe there are signs for a trend.
Is there also the potential that you're actually overachieving your asset under management targets, given that trend and that really tectonic shift, how money is flowing across the globe?
It's too early to tell. But again, we confirm our €4.50 target for the year. We believe it is both realistic and achievable. When we have been talking about it in the past, we have been using a bridge to explain it how to get there. The bridge has been based on three core assumptions. The first one is the reduction of certain cost items. The second one is increasing delivery of performance fees. And the third one is assets under management growth. We remain diligent in managing our costs. We have positive momentum with performance fees and assets under management, despite the fact that the recent market turmoil has impacted that level somewhat. Still, our average assets under management in 2024, which is the target bridge assumption, is below where we are currently. So, but there's still obviously in this environment the volatility in the market has widened the range of possible outcomes.
Markus, thank you very much. So guys, with that, I'm sending back over to you. So there's also some beneficiaries, I have to say, from when we look at this market turmoil, and especially Europe might actually be winning from that whole situation, but probably it's too early to call a final decision on that.
Annetta, thank you very much for bringing us the latest there. Let's push on to Canadian politics, and Mark Carney's Liberal Party has won the Canadian federal election according to national broadcasters CTV and CBC. However, it's still unclear whether his Liberals have secured a majority. The party was given little chance of winning before the former Bank of Canada and Bank of England governor took the reins. He has presented himself as a vocal challenger to Donald Trump's tariffs and threats of annexation, a message that appears to have resonated with the Canadian voter. So the 51st state, of course, those comments from Trump having some bearing here.
No, not having some. I think you've underplayed, which is very rare for either of us. I think it is 100% down to Donald Trump. The Liberals were nowhere after nearly a decade of Trudeau. They were nowhere. Poilievre was way in the driving seat, and we saw it with the appointment of Susan Crawford in Wisconsin with the judge. I'm tying the two together because I think it's important to see that there is a Liberal backlash going on to what we're seeing with the rise of the strongman, with the rise of the likes of Trump. And it's very, very interesting that it's going on through the electoral process as well. And I would tie those two things together. So a direct result, as you quite rightly said, the 51st state, even up until the last 24 hours, he was still going on about it as well. This is the backlash, and now actually he's given himself potentially a tougher bargaining position against Mark Carney, who's already said the relationship between the States and Canada will not be the same again.
I mean, we've all met Mark Carney a number of times, and he's a very strong player and very strong when it comes to the economy. But the other feature here, of course, was Justin Trudeau's fading star power. Big, gigantic name when he first came to power, but that star had well and truly faded. So I think the handover here was significant too.
I think what's remarkable about Mark Carney is that he's never held an elected position before. He was a central bank governor, obviously, but he...
Very political positions.
So a political position, but not an elected politician.
Bank of England in when did we Brexit? 2016.
Yeah.
So he's kind of been around for some big
He's been around,
points.
but not in this capacity. And I think what's particularly interesting is that we have seen, until this stunning election, we have seen President Trump's election spur support for far-right parties in other parts of the world, spur support for populist parties. But this is a completely different impact, this backlash that we're seeing. And I think it will be interesting if we start to see this trend take place in other parts of the world.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.